Hello everyone, and welcome to this week's episode of the Financial and Lifestyle Freedom Podcast with me, Annette Ferguson. Now, I am recording this before I go away on half term. So, as you are listening to this, as this is being released, I'm actually on half term with the kids at the moment. So, hopefully, I'm having a lovely and wonderful time. And today, we're going to be diving into a topic that is absolutely critical for small business success, and that is financial forecasting. That can be a scary sounding phrase for many people. But financial forecasting isn't about predicting the future, it's about being prepared for what the future might throw your way. So, whether you're looking to grow, scale, or just maintain stability, this episode should give you the insights and tools you need to create financial forecasts with confidence. So let's get started. First off, let's define financial forecasting. At its core, financial forecasting is the process of predicting your business's future financial performance based on historic data, market conditions, and your future plans. It's about using data to make informed decisions, whether that's about hiring, expanding, launching new services, or simply keeping the business running smoothly. When done right, financial forecasting allows you to anticipate potential cash flow gaps, plan for growth, and avoid the stress of financial uncertainty. So, why is this so important? Well, without a forecast, you're essentially driving your business blind. You might be making great sales today, but do you know what your revenue will look like in 6 months' time? Are you aware of upcoming costs that could impact your profitability? These are all questions that a financial forecast answers. So let's start with revenue forecasting. This is where you estimate the income you are expected to generate over a specific period, usually monthly or annually. It's based on your historic sales data, market trends, and any changes you expect in the future. So here's how to calculate your revenue forecast. First of all, gather your historic sales data. Look at how much revenue you have made per month over the last 12, 24, 36 months. Are there any trends? Do some months perform better than others? And what is the growth that you've historically achieved? 2. Factor in market conditions. Are there any external trends or economic conditions that could impact your sales? For example, if you know your industry is growing, you might factor in growth to your forecast. And 3, applying growth assumptions. Based on the data and market analysis, you can estimate your growth percentage for the next period, whether that's 5%, 10%, or 20%. Be realistic though, but a little ambitious at the same time. One big mistake that so many people make with revenue forecasting is getting very overexcited, assuming that they can get growth rates well beyond what they have historically managed to achieve. And whilst that sometimes happens for some businesses, it is in reality rare. So do make sure that you are realistic when you're looking at a growth percentage. And don't forget, you can also factor in different scenarios: best case, worst case, and most likely. That way you can plan for a range of possibilities. Now we've covered revenue, let's speak about expense forecasting. Just as important as forecasting how much money will come in is understanding how much money will go out. So here's how you forecast your expenses. Identify your fixed costs. That are things like rent, salaries, insurance. They don't change that much from month to month. And then list your variable expenses that fluctuate with the level of business activity. That might be marketing, it might be utilities or suppliers. Make sure that you account for these and predict how they will change as the business grows. And then plan for one-time expenses. These might be big purchases or a project coming up. There might be equipment upgrades or new hires or new marketing campaigns that you need to put into your forecast. By planning ahead for these expenses, you will be better prepared to manage your cash flow and avoid financial stresses. It will also help you identify areas where you might need to cut costs if needed. And let's now talk about cash flow forecasting. Cash flow is the lifeblood of any business. You have heard it said, I am sure, 1,000 times. And cash flow forecasting ensures that you'll have enough cash on hand to cover your expenses even during slower periods. So here is how you then forecast your cash flow. You need to first of all estimate your cash inflows. This includes all the money that's expected to come into your business, whether that's from sales, accounts receivables, or perhaps even loans. And then, secondly, you need to estimate your cash outflows, the money going out. You need to include things like rents and salaries, but also stuff like loan repayments, equipment purchases, hire purchase agreements, payments in tax. All of those outflows need to be included. And then you need to calculate your cash gap. If you see a month where the cash going out is more than coming in, then you need to get a plan in place for that. Whether that means saving ahead or delaying certain expenses, but you need to work out what needs to happen so that that cash gap does not exist. Remember, cash flow isn't the same as profit. You might be profitable on paper, but not have enough cash in the bank, and your business can still struggle. So finally, how do you then use your financial forecasts to drive strategic decisions? So forecasting isn't just a number crunching exercise. It's a way to guide your business growth and long-term success. For example, if your revenue forecast shows strong growth, you might decide it's time to hire more staff or invest in new equipment. On the other hand, if your expense forecast shows increasing costs, you might want to hold off expansion until you can stabilize your outflows. In short, your forecast helps you to make smart, data-driven decisions. It gives you the confidence to know when you can take risks and when you can play it safe. So to wrap up, financial forecasting is one of the most powerful tools you have as a business owner. By forecasting your revenue, expenses, and cash flow, you can plan for the future with confidence and avoid financial uncertainty. And if you are ready to dig deeper into this topic, I have 2 resources for you. One is our financial forecasting toolkit. It is completely free, and the link is in the show notes to download that. The second is my book, The Profit Plan. You can get that on Amazon. It is only 77p, and I believe it is also on Kindle Unlimited as well. You just need to go to Amazon, type in The Profit Plan. You can put Annette Ferguson in there and it will come up. So thank you so much for tuning in today to our episode. If you have found this helpful, I would love if you want to make sure that you subscribe to the podcast. Please do share it with any fellow business owners that you think will benefit. And if you possibly can, please do leave us a review in whichever podcast player you happen to be listening in. Until next time, I will speak to you soon.